Hello, everyone. So in this video, we're going to be looking at what is the best vehicle or the best methodology for you to be investing in. Is it a personal name or is it a limited company? Now, obviously, this is not personal tax advice. This is you should definitely be going out to seek your own personalized tax advice. This is very generic advice. However, it is a very common question that we do get asked by those who are looking to invest in a professional way in property. So a bit of a background is that there is a conception that a lot of the sort of move into personal into limited from personal into limited company has been driven by the introduction of clause 24. Now, for those of you that don't know, clause 24, it was simply the government or introducing regulation which said that the interest proportion of your mortgage is no longer deductible as an expense if you are investing in your own name. All right. So in other words, what they were saying is if you invest in your own name, move it into a company or start buying in a company to allow that for that to be an allowable expense. That is true. However, another aspect to consider is that actually investing in a limited company has always been the best way long term for professional investors to be investing in property. Lending was always the issue. And the introduction of Clause 24 forced lenders to then move and allow lending to limited companies on a much easier in a much easier way. So that's a bit of background as to how we got here. Now, in terms of why you would invest in a limited company, I mean, the short answer is tax efficiency. Like bar none, it is much more tax efficient to be investing through a limited company. So one of the considerations is obviously, as I've mentioned, interest is now an allowable expense if you're investing through a company versus whether you are investing in your personal name. Secondly, your tax rate, your corporation tax rate, will likely be lower than your personal tax rate. So corporation tax at the recording of this video is 19 to 25%, depending on your profit. Okay. But for most people, and property is such that most of your expenses are front loaded, you will likely be paying that 19% corporation tax, which is lower than most individuals' personal tax rate. The other thing is, we have to remember that these are two separate entities. One is you as an individual, one is a limited company of which you are likely a director or shareholder. So what that means is you can choose when you pay tax. And you might say, well, no, that's not true because I'm paying corporation tax. Yes, the limited company is paying its corporation tax. You, as an individual, as a director or shareholder, is not necessarily going to draw that money out straight away. Because if you had, for example, easy maths, you had £1,000 in profit, you've paid your corporation tax, whatever's left over, you would want to take out for your income as an individual from as a director or shareholder in that company. You may think, well, I don't want to take that out because I'm a high rate taxpayer already. Why would I want to draw that out and then pay a higher rate of tax on that income? And the answer is you don't have to. You can just leave it in the company, let it be, and potentially utilize it in the future. Or should you choose to eventually transition into a full-time investor, you can then utilize that income. So you effectively choose when you, as an individual, i.e., director or shareholder, then pay your tax on that amount of profit versus if you had to earn £1,000 in your personal name, you would then have to put that on your annual tax return. So you will be paying that tax on the year in which it is earned, in which that profit is earned. Okay, that's a huge consideration because for some people, this might be a 5-year journey where one of the goals is let's get myself out of my job and move into professional investing. Well, how do I do that? Well, knowing that I've built up profit in my limited company means that I can then, in a tax efficient way, keep myself mortgageable by having income from that property. There are other considerations. For example, you might want to do intercompany lending. So, if you are moving towards investing as a professional, you may have a holding company and you may have a trading company where you buy and sell projects, where you buy and sell flips. Those could then do intercompany loans. They're not done through you, that were done between the companies. You could also, for example, have a consultancy company, which then charges management fees to each of those companies, further reducing your income and allowing you to create a sort of third party income, which is your general services company or consultancy company. Okay. And I mean, this is just the very, very tip of the iceberg in a very short video. The short thing is there is a lot that you can do, some of which, particularly as I remember from my own personal journey, you kind of think, how is that legal? But it's all perfectly legal. And one of the things to consider is how do big corporations operate in the country, and how do they invest in the sector in which you are investing? You just do the same thing that they do on a smaller scale, because they'll be abiding by the rules. So you just abide by the rules. We in no way are looking to promote any sort of tax avoidance or evasion. Pay your dues, pay your tax, but there is a much more efficient way than just going out, buying a house, taking that income, and then all of a sudden having to pay that tax. So our recommendation, in case you haven't picked this up by now, is obviously to look at forming that limited company and moving forward in a much more tax efficient way. There are lender considerations that you would need to think about. Now, in terms of the challenge, the sort of not disadvantages, but considerations that you would have on a limited company. Number one, you have overhead costs. It's going to cost money to run that limited company, accounting fees, bookkeeping fees, potentially slightly higher lending rates from lending companies. However, that is very much mitigated by the tax efficiency thereof. Also, you do have fiduciary responsibilities, which means you have legal responsibilities, whether it be to government, to HMRC, depending on how you might set that company up. So I hope that's given you a brief overview of how you might utilize a limited company and given you some food for thought as to how, what is your best option. But as always, seek personal professional advice, and we look forward to seeing you on your investing journey.